The first step in assessing whether your company has the right amount of debt, whether it's borrowed too much or too little, is to do a qualitative analysis of your company, often in comparison either to the industry or to other companies. And in this session, what I'd like to do is take you through the trade-off, the steps in the trade-off, the pluses and minuses of debt versus equity. So let me start by setting the table. The trade-off on debt versus equity is a very simple one. When you borrow money, you get two big advantages. The first, of course, is a tax advantage. In most countries, interest is tax deductible. Cash flows to equity, on the other hand, are only partially tax deductible or not tax deductible at all. So other things remaining equal, the higher your tax rate, the greater the tax benefit to debt. That's true pretty much in most developed markets, and it's more true in some markets than others, but it remains true in every market. The second big advantage of debt is the fact that debt can sometimes make managers at companies more disciplined about the way they pick projects. The argument here is based on the notion that what's good for managers is not often what's good for stockholders, and managers left to their own devices, especially at mature companies with lots of cash flows, can become sloppy. So what you try to do is you force them to borrow money, because then if they're sloppy and take bad projects, the consequences are that they might not be able to make the interest payments and they could go bankrupt and lose their jobs. I know it's an extreme way of getting somebody's attention, but if nothing else works, I guess this is your last resort. So the two big advantages are tax benefit and added discipline. On the other side of the ledger, there are three big costs. The first, of course, is an expected bankruptcy cost. That's a function of two variables. One is the probability that you will go bankrupt, and that'll always go up as you borrow more money. I don't care who you are. You could be ExxonMobil, but your likelihood of going bankrupt is greater if you borrow an extra 10 billion than before you borrowed the 10 billion. And the second is the cost of going bankrupt, which can be broken down into both direct costs and indirect costs. Direct costs capturing what happens after you go bankrupt, and indirect costs capturing the consequences to you as a company if people perceive that you might go bankrupt, that you're in trouble. So that's the first and the biggest cost of debt. The second is an agency cost. When you borrow money, you bring lenders into the equation, and what's good for lenders is often not what's good for equity investors. And you set up a potential conflict of interest. That conflict of interest plays out in many ways. One is that as borrowers, if you face a substantial conflict of interest, lenders are going to charge you either a higher interest rate or put constraints on what you can or cannot do. Covenants, essentially, on you as a company. And the way I would describe it is when you borrow money, you put yourself in a straitjacket. And the more you borrow, the tighter the straitjacket gets. Again, the higher the agency cost to a company, the less it should borrow. And the third is every time you borrow money, you give up some future flexibility. It's nice to have some excess debt capacity in case you need it. So that's a trade-off. And the question then becomes, how do we apply this trade-off in individual companies to decide whether they can borrow a lot of money, not very much money, or no money at all? So here's the first step in the trade-off. When you look at your firm, you want to look at the potential tax benefits to borrowing, the potential for using debt as a mechanism to discipline your managers, the potential for creating expected bankruptcy costs in your firm, the potential for agency costs in your firm, and the need for flexibility in your firm. The key word is your firm. That trade-off might give you the answer in your firm that your firm should borrow a lot of money, but for your neighbor's firm or your friend's firm, it might not get the same answer because that firm might have very different characteristics. And once you've come up with a judgment on how much your firm should be borrowing, then you can look at what the company actually borrows to see if in fact it matches up to what you'd expected. So let's start in the process. If you're looking at your firm and say, what are the potential tax benefits to my firm from borrowing money? The first thing to look at is the marginal tax rate of the country in which your company is domiciled. I know companies can be multinational, but I'm making the assumption here that the country in which you're domiciled is the one where you get the bulk of your income, the largest share of your income, and therefore you care about more. Now, of course, with multinationals, you might get only 25 or 30% of your income from your domicile country, and that's where the effective tax rate comes in. So it's possible that when you have a company that's in many countries with low marginal tax rates, their effective tax rate can be lower than the marginal tax rate. So to look at whether my company will get substantial tax benefits from borrowing, I'm going to look at both the marginal tax rate and the effective tax rate. So as I go through this process, I'd like to use a company as an example. The company I'm going to use is Hewlett-Packard, and I'm going to pull up the Excel spreadsheet that I have for Hewlett-Packard as I go through so you can see what the numbers look like for Hewlett-Packard. So let me make these numbers a little bigger so you can see them. So let's start with the tax benefit. These are HP's numbers from 2012. Their effective tax rate was 21%, and the marginal tax rate in the US is about 40%. Now, before I get a little deeper into this process, to give you a sense of whether those numbers are high or low, let me lay out the picture at least of what marginal tax rates look like around the globe. These are 2012 marginal corporate tax rates by country, at least most of the countries that I could pull the data for across the globe. And you can see that at the very top left-hand corner, you have the tax shelters. These are usually very small, usually islands. A few are in the Caribbean, a few are off the coast of Europe. And they're usually places where you go to hide your income from taxes. So they have zero tax rates, but they're the exception rather than the rule. The rest of the world, for the most part, you pay taxes, and the tax rates vary. They vary from fairly low numbers in Asia and Eastern Europe to slightly higher numbers in Western Europe to much higher numbers in Latin America, and the highest numbers are actually in North America. And the US has one of the highest marginal tax rates in the world. Now again, keep this in perspective. If you're a US company, it doesn't mean that all your income gets taxed at 40%. If you're a multinational and you get your income from all over the world, only the portion of your income in the US that's in the US gets taxed at 40% right away. The rest of your income gets taxed at the rates of the country in which you make that income, and it's only when that money comes back to the US that you have to pay the differential tax. So if you're a US company, you care a lot about you care the most about the marginal tax rate in the US, but to the extent that you have income from outside the US, you can alleviate that impact a little bit. So your marginal tax rate in effect could be lower. Now, when we talk about effective tax rates do vary across sectors, and these are the average effective tax rates across just money-making companies by sector in the US at the start of 2013. The reason I emphasize only for money-making companies, if you have a lot of companies that lose money in a sector, the average effective tax rate can be lowered because those companies don't pay taxes. So it's not quite fair to look at that rate. So looking at just the companies that pay taxes, the average effective tax rate across all of the US is not bad. It's about 28%. I mean, the conventional wisdom that US companies hide a lot of their income from taxes doesn't seem to hold up when you actually look at the taxes paid. They do vary across sectors. The pharmaceutical sector, for instance, has a far lower tax rate than some other sectors. Like, for instance, if you look at power, the tax rate is 34%. Utilities pay much higher tax rates. It's much more difficult for those companies to kind of move their income around and shelter themselves than other companies. So you can see that the tax rates vary across sectors. Now let me return again to the HP example now that we have a little bit of perspective. HP's effective tax rate is 21%. I've defined HP's sector as computers peripherals. I mean, you might use a meld of sectors here. But the average effective tax rate for the sector is 23%, based just on the effective tax rate. You could then argue, and this is a little dangerous because you're building it off one number, that HP gets a smaller tax benefit than the typical company in the sector, therefore it should borrow less money. You'll notice that I've shaded that number green. And here's what I'm going to do with each number in my comparison. If it's pushing me towards a lower debt ratio, I'm going to shade it green. If it's pushing me to a higher debt ratio, I'm going to shade it red. Now, when it comes to marginal tax rates, the marginal tax rates for all US companies is 40%, so I've kind of left it there. But if you wanted to bring in the global revenue breakdown for your company versus the sector, you could make that comparison as well. So in taxes, not a huge push towards more debt for HP. It looks like it actually gets a slightly smaller tax benefit than the typical company in the sector. Now let's go back to the slides. Okay? Once we've got the tax benefit nailed down, the next issue, of course, is added discipline. Now, added discipline, as I said, reflects the fact that at some companies, managers are not very good about the way they pick projects. And because there's a breakdown of what's good for managers and what's good for stockholders, a conflict of interest potentially, you might force the managers to borrow more money to fund their projects because that'll force them to be a little more careful about the projects they take. Now, what are some of the variables you might want to look at to see if your company is a good candidate for this particular argument for debt? First, you can look at the past project choice. The worse the projects are that a company has picked historically, the more you're going to push that company to borrow money to fund its projects because discipline is such a big part of it. I mean, you need to be disciplined only if you're not taking projects well in the first place. You should probably also look at past stock price performance. To the extent that bad projects feed into bad stock price performance, a company that has underperformed the market, remember we talked about Jensen's Alpha as one measure for this, are better candidates for borrowing money than companies that are already overperforming or outperforming the market. I'd also look at the insider holdings. The argument here is if you're a company where the top managers hold a lot of stock in the company, you probably don't need debt as a way of disciplining these managers because they already think like stockholders. I would not require debt at Dell to make Michael Dell more disciplined about the way he picks projects. He already owns 16% of the company. He should think like an owner first and a manager later. So I'm going to look at the percentage of insider holdings. And I'm also going to scan the top stockholders in the company to see if there are any activists there. The argument being that if I have a Bill Ackman or a Carl Icahn on the list, I don't need debt to discipline managers. Those activists might do it for me. So let me again leave this page and go back to the HP, to the comparison page for HP to see how HP measures up. And here on all three variables that I looked at, it looks like HP is in need of added discipline. First, its insider holdings are tiny, 0.09%. The top managers own very little of the company. The typical company in the sector, you find about 6.22% of the stock being held by insiders. So because insiders hold less stock, you would think that they would need to be prodded from the outside. And that's where debt comes in as a disciplining mechanism. And that's why I've shaded it red. That pushes HP towards more debt because managers don't own very much stock. The return on invested capital for HP looks pretty good at first sight, 11.88%. But for a technology company where invested capital is already understated, that's not a very good number. In fact, the sector average is 34.66%. So that number suggests HP has not been taking very good projects. That again is an incentive for HP to borrow money to make itself more disciplined. Then looked at the Jensen's Alpha, and the bottom fell out of HP's stock over the last 3 years. Its stock went from 42 down to 14. That suggests again that maybe there's a need for outside discipline here for HP's managers. And that plays out when I compare that Jensen's Alpha to what was typical in the sector. The typical computer peripheral company actually outperformed the market. HP underperformed. So all three numbers here suggest that HP could come in for some good disciplining from the outside with the use of debt. So on that measure, it looks like HP should borrow more money. Let me go back to the slides and look at the next item on the trade-off. So we looked at the two benefits. Let's look at the costs. When you think about the expected bankruptcy cost, the first thing you're looking at is the probability of bankruptcy. There you can look at quantitative measures. One is you can look at how much in earnings and cash flows this company has to service debt. Obviously, the more cash flows you throw off as a company, the more you can afford to borrow. But you're also going to follow up to see how variable those earnings are. The more variable the earnings are of a company, the less it should borrow, because the more variable earnings are, the more you have to worry about what if something goes wrong. So the higher the level of earnings, the more you should borrow. The higher the variance in those earnings, the less you should borrow. And if you're a company that's dependent on one or a few customers, you get 45% of your revenues from Walmart and you're an apparel company, you need to worry a lot more, because what if that contract gets canceled? So those are quantitative measures. On the qualitative measures, you want to look at the possibility of a catastrophic risk. So if you're a company, an insurance company, and you worry about, a hurricane or an earthquake causing a huge amount of damage and costs, you might borrow less than you otherwise would have given your earnings. If you face a lot more competition, my guess is your earnings are going to be a lot more variable and volatile. It doesn't always happen that way, but I would assume that the more competition you have, the more uncertain you are about earnings and the less you should borrow. And thirdly, you should look at product type. If you're producing a product that lasts forever, that has a long life cycle, you can afford to borrow more than companies that produce products with very short life cycles. A classic example is Apple with its, look at how quickly it went from being hero to goat, how quickly your products can shift in a market like that one. So that's a probability of bankruptcy. And the cost of bankruptcy comes from two places. One is the direct cost, which you can measure it by looking at what kind of assets, again, the company has. If a company's assets are liquid and easily marketable, it has lower direct costs, because then if you go bankrupt, it's easier to sell off your assets. That's why if you're a hotel company and you get into trouble, selling off your assets is easy. You have a bunch of real estate that you can sell off in different parts of the country. If you're a casino company, it's going to be more difficult because your real estate is so much larger and there are fewer potential buyers. And if you're a company whose assets are kind of difficult to separate from each other, then it becomes much more difficult to liquidate you, which means the legal costs are going to be much higher if in fact you go bankrupt. The indirect cost, you have to put yourself in the shoes of a customer or a supplier to the company and ask yourself, if this company got into trouble, what would I do? If your answer as a customer is I'd stop buying their products because I'd be worried about whether they'd be around to service it, then that's a big indirect cost. If you're a supplier and say, I'm going to demand cash with this company if it gets into trouble, that's an indirect cost. So those are the indirect costs you got to build into the process. So let's again look at HP to see how it measures up on those issues. So if you look at the probability of bankruptcy, I looked at two variables. I looked at how much cash they had by looking at their EBITDA, it's the earnings before interest, taxes, depreciation, amortization, as a percentage of their market value of operating assets, enterprise value. That gives you a measure of how much cash the company has available. And HP has about, if you look at its EBITDA in 2012, it might not be sustainable. Its EBITDA was almost 31 cents for every dollar of enterprise value. That's huge. Relative to the sector where that number was 13%, that suggests that HP has a lot more cash available to service debt than the typical company. And the variability in earnings for HP is also lower than is typical for the sector. And the way I measured the variability in earnings for HP was I actually went back and looked at about 7 years of earnings, computed the percentage change in earnings every year, and I computed the standard deviation of that number. Now you can come up with your own measures of variability, but no, that seemed like a simple way to do it. And for the sector, that's about 23.55%. So both in terms of how much cash they have and how volatile the cash is, HP has more cash and has less uncertainty about that cash. So that would suggest in both variables that the probability of going bankrupt is lower for HP than the typical computer peripheral company. As for cost of bankruptcy, I'm going to use fuzzy measures. I don't see how you can break down HP's assets and sell them off in pieces. I would assume that these are fairly liquid assets that are difficult to separate out. I would also assume that the cost of being in trouble is somewhere in the middle. It's not a grocery store where you don't care at all as a customer. As a customer buying a printer, I would worry about HP being in trouble. But then again, my printer doesn't last for more than a year and a half or two. I'm not going to worry too much. This isn't an aircraft I'm buying. So I'm going to put it somewhere in the middle. And I would argue that the characteristics are pretty similar for the rest of the sector. So on both of those, I'm kind of leaving it neutral. HP is no better, no worse than the typical company in the sector. Then let's get back to the trade-off and let's look at the next cost in the trade-off, which is an agency cost. And to think about agency costs, the best thing to do is think like a lender. Think like a lender lending to this company and think about everything that might worry you. And here are some things you probably will think about. What are the assets that this company has? Presumably, if you're thinking about, hey, can I see those assets? Are they physical assets? Do I feel comfortable seeing that they're there? You'd probably feel a little uncomfortable lending to companies that are more intangible assets than to companies with more physical fixed assets. You could also check to see how easy it is to monitor what the company does. In other words, if it's a manufacturing company, you can walk into the plant and see what they're doing. If they're a technology company, you have no idea what they're doing. So it's much more difficult to monitor what companies do. And if the companies borrowed in the past and paid off money in the past, it does make you feel a little more comfortable. Maybe it shouldn't, but it does. So the fact that a company has a good history of borrowing money and returning it can feed into your decision to feel comfortable lending to the company. So let's see how HP measures on those dimensions, on the agency cost. And here I looked at 4 variables. I looked at fixed assets as a percentage of total assets. For HP, that number is a fairly low number. Their fixed assets, the physical assets, are fairly low as a percentage of total assets. It is difficult to monitor the assets, so the worry is going to be high. But again, this is going to be true for both HP and the rest of the sector. Then I looked at the price to book ratio. It's market value of equity divided by book value of equity. You're saying, what does that mean? Loosely speaking, the higher that number, the more value that the market is attaching to future growth. And if I'm a lender, I'm a lot more wary about lending on future growth than on existing assets. So lower numbers there make me feel more comfortable about lending to a company. Higher numbers make me feel more uncomfortable. HP's price to book ratio is 1.31. The average for the sector is 3.57, much, much higher. So on that dimension, at least, I feel a little better about lending to HP. And HP, unlike most other computer companies, has a history of borrowing. They actually have bonds outstanding. They've paid these bonds. So on that dimension again, I feel better about lending to HP than a company that's never done this before. So on two of those four variables, at least I'm getting signals saying go out and borrow, go out and lend more. Or if you're HP, go out and borrow more money. Now, let's look at the final factor here, which is financial flexibility. What am I talking about here? Every time you borrow money, you're giving up the capacity to borrow that same money in the future. And the more you worry about, will I need that debt capacity in the future, the less you're going to borrow now. So to get a sense of how much you're going to value this, I'm going to look at two things. One is how much financing needs you have, how much reinvestment do you do as a company, and how predictable are those needs. It's going to be a little difficult to measure, right? So here's how I tried to do it for HP. I looked first at R&D, which for technology companies is a true measure of reinvesting, because if you look at the net capex as a percent of sales, it's tiny for both HP in the industry, though HP's number is actually negative, which means they don't have very much capex in the first place. And if you look at R&D, HP's R&D as a percent of sales is a lot lower than it is for the industry. So HP is basically reinvesting a lot less than the typical company in the industry, which by itself should push me to borrow more money. There's one thing, though, that might push HP to be a little cautious about using debt capacity today. It has acquired some big companies in the last 10 years. In fact, their acquisitions as a percent of sales are much higher than for the typical company. So I've made it green with a caveat, which is given the history of bad acquisitions HP has made, maybe as HP stockholders, this is exactly the kind of investment I don't want them to make. So maybe the best thing to do is actually make them borrow more money so they don't have the debt capacity to go out and do more acquisitions. So maybe that green should really be a red, and it'll be a red partly because of the history they have in these acquisitions. So if I take into account the big picture and look at all of the variables, it's quite clear that far more variables would push me towards expecting HP to borrow more money than less money. So I would expect to see HP have a much higher debt ratio than the industry. And that's what I see. HP's actual debt ratio is almost 50%. What's typical for the industry is 8.84%. Now, of course, the question we have to ask is HP's debt ratio is high. That's what I'd expect. Is it too high? Now, that's a problem with just having a qualitative analysis. I cannot quite answer that question. I need more precise tools to be able to do it. But you can already see that if you can have 5 or 6 companies in your comparison, which you can have as a group if you're analyzing this project, the analysis gets a lot richer. You can compare your companies on each of these variables and tell a fairly rich story based upon just the qualitative trade-off as to which companies in this mix you'd expect to see have higher debt ratios, which companies should have debt ratios in the middle, and which companies should have low or even no debt in their financing mix. And it's, as I said, a good place to start. We're not going to end with this. We're going to come back and revisit this question in more detail. But start with this qualitative trade-off to get a sense of what the borrowing capacity is for your company. That's about it. I'm glad you listened. Thank you.